Back then, gold was already trading at or close to all-time highs in many currencies, like the Canadian dollar, like the Australian dollar, in many emerging market currencies, and also in euro terms. But everybody's just staring at the dollar price of gold, and now we are already also seeing that gold is trading in a solid uptrend in dollar terms.
Hello there, my friends. Just a quick note before we get started. This coming Tuesday, February 4th at noon Eastern, going to be doing a gold and silver live roundtable. Excited to be joined by Rory Hall of the Daily Coin, Phil Kennedy of Kennedy Financial, and James Anderson of SD Bullion. Again, it's going to be a live one, so we will be taking questions, anything you're wondering about gold and silver. So if you hit that little notification bell right below there next to the subscribe button, you can be notified, or you can just check in next Tuesday at noon Eastern. And with that said, here is today's episode. Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and excited to have a return guest on the show today who perhaps knows more about the gold market than anyone else on the planet, because in addition to running his fund with Incrementum, advising gold companies, and writing the legendary In Gold We Trust report, Ronnie Stöferle is kind enough to join me on the show. And it's been on before, and it's great to catch up, follow up on some of the things we talked about last time. Real quick before we get started, hit that little bell next to the subscribe button. You can hit that one too, but this way, when I'm blessed to have intelligent, brilliant folks like Ronnie on, you can be notified as soon as that happens. And with that said, Ronnie, pleasure as always to catch up with you. And how are you doing today, my friend?
Thanks a lot, Chris. Happy New Year. I hope it's not too late to say Happy New Year. All good over here. I think January has already been quite a volatile and interesting month, and yeah, I'm really looking forward to the rest of the year. I think it's we won't get bored.
That is for sure. Happy New Year to you. And I guess we're almost, what is today? January 29th. So a 12th of the way. Soon it'll be Happy New Year 2021. Amazing how quickly it goes, and also amazing some of the things that are happening in the markets today. Obviously, the Federal Reserve is, I don't know if you would call it a hyperinflationary campaign yet, although it's getting a little bit silly here. Obviously, folks are looking towards gold. Kind of seen it be a little choppy lately, but fortunately, that's why we have the expert in here. So how about you take it away and let us know what's happening?
Yeah, well, I think, if you want to have the short story, I think that gold is back in a bull market. That's my core of my whole thesis. We wrote about that already last year in our In Gold We Trust report 2019, when we said that once we go above that massive resistance at 1360 to 1380, momentum will kick in, and then actually all hell will break loose in the gold markets, and we can easily go to 1600. So this call last year in spring 2019 was really accurate, and that was based on our analysis of gold in various currencies. So back then, gold was already trading at or close to all-time highs in many currencies, like the Canadian dollar, like the Australian dollar, in many emerging market currencies, and also in euro terms. But everybody's just staring at the dollar price of gold, and now we are already also seeing that gold is trading in a solid uptrend in dollar terms. Actually, gold was up 19% last year in dollar terms. It was up 22% in euro terms. It was up 17% in Japanese yen. It was, of course, up in Australian dollars and Canadian dollars. So gold is back in a broad bull market. And the beauty of it is that we're seeing that many market participants are kind of waking up, but I don't see any buying panic. I don't see Wall Street analysts like back in the day in 2011, where basically they all extremely aggressively raised their price forecasts. Back then when gold was trading at 1700, many of the big banks like JP Morgan, but also Goldman, they had like really high price targets around 2,500, even 3,000 US dollars. We're far away from that. It will happen at the end of the trend, but now at the moment, I would say that wealth managers, high net worth individuals, they're picking up on gold again. They see potential here. Of course, we have seen very well-known big investors with a very good track record like Paul Tudor Jones or Sam Zell or also Ray Dalio saying that you should or you have to own some gold. So my view is crystal clear. We're back in a bull market. There will be corrections within the course of this bull market, but you should take those corrections as an opportunity to get more exposure in gold, in silver, but also in the mining stocks.
Well, a lot of interesting points you mentioned there, especially about 2010, 2011. I remember that was back in my trading floor days, and while I agree there were a few analysts calling for higher gold, you know how us Americans are. We like buying when things are moving and following momentum, bake in that buy high, sell low strategy. Although it was interesting, I was talking about gold and silver on my post on the New York Stock Exchange, but everyone looked at me like I was insane. So I think there was very few people that were actually buying gold or actually paying attention to any of those forecasts. Yet, I'm curious or if you have any thoughts. Obviously, we've seen JP Morgan get charged with the RICO Act here, the Department of Justice describing them as a criminal racket. And one of the things that always opened my eyes was back when gold had crossed 1900 in September of 2011, and then in the middle of that holiday weekend, you had the Swiss announce they were going to peg the franc to the euro. This was just after the U.S. had been downgraded. And then we saw the price of gold plummet. So I'm curious if you think much about the effect of all this short paper selling and how that affects things. And are we in a situation where at some point that's going to be overwhelmed and that's when we do see the higher prices, or do you not see that as a big of a factor?
Well, I would say the let's call it the paper market is something that I cannot really influence. So I have to be agnostic. I've got a private opinion on those developments, but I think it is, like many people do say in the gold sphere, it is, for me and my analysis, it's not enough to just blame, the manipulators when gold goes down. So we wrote roughly 3,000 pages of research about all factors influencing gold, and if there would only be one number that I would have to take, it would be the direction of real interest rates. And we should not forget that in 2011, as I've said, everybody was already extremely bullish. We had, on magazine covers, we had really euphoric calls for significantly higher gold prices, for 10,000 US dollars price targets, really coming from mainstream magazines. We had really aggressive positioning from many large institutional players in the market. So from my point of view, in hindsight, it was pretty obvious that this was the top, but of course, it always is in hindsight. But I think what's really important to as a takeaway First of all, if you want to have gold as some sort of a systemic hedge, if you really want to have it as a insurance, or as Grant Williams calls it, an unsurance, because if you're unsure about the future, then you should have, of course, at least some gold. And the more unsure you're about the future, the more gold you should probably have. So if you're concerned regarding hyperinflation, financial repression, monetary reform, whatever, then you should have gold, and then you should have physical gold. Then you should care about counterparty risk. Do you really want to store it inside the banking system? Then you shouldn't own any paper gold, any futures contracts, or certificates on gold, ETFs, whatever. So I think this is really something that I want to highlight. When it comes to the whole manipulation, I would say, of course there's interventions happening. I don't think that central bankers want the price of gold rising dramatically, because that basically would mean that the trust in fiat currencies, in the US dollar, in the euro, whatever, is falling off a cliff, that people just don't want to hold paper currencies anymore. So therefore, I think in such stress situations, of course, central bankers don't want a quickly rising gold price. On the other hand, I think it's fair to say that the job of central bankers is not staring at their Bloomberg and having a look at the price of gold. It is the manipulation of the most important price in an economy, which is interest rates. So nobody is really talking about the manipulation of interest rates that affect us and our lives and society so much. And that's also the reason why we published a book. In German, it's called Die Nullzinsfalle. In English, it's called The Zero Rate Trap, which describes all those pernicious consequences of interest rates being too low, what it does to our society, and I think this is really something that's very, very important. And of course, gold is also some sort of the mirror image of interest rates, because if real rates should go to plus 5 or 6% again, then of course you shouldn't own too much gold anymore. But can we really afford those real rates due to the whole debt situation? I highly doubt that. So is there intervention happening in the gold market? I think so at some stages, but this is definitely not the most important and the most relevant driving factor for the price of gold.
Another series of great points you mentioned in there. Geez, we're going to have to get you on more often, or write a book one day, because in 2 or 3 minutes, you mentioned so many interesting things. And I do agree, not just the gold market. I wonder what Ludwig von Mises would think about the Federal Reserve just arbitrarily deciding what interest rates should be, whether you call that bond market manipulation or policy. Yet you did mention that the central banks don't want people buying gold, although is interesting, and I'll bet you'd probably be more qualified to comment on this than just about anyone else. Continue to hear that the central banks, I believe last year, they bought the most gold since 1971. Any thoughts on that? And you expect that to continue this year?
Yeah, well, I think this is also something that we described in our last In Gold We Trust report, where we talked about the loss of trust and this crumbling trust that we're seeing in many areas of our lives. We're seeing it in the media, of course, where mainstream media is just losing trust. We're seeing it when it comes to politics. The gap between the right and the left, and whatever you want to call those different views, is getting bigger and bigger. It's getting more polarized, and at some point, I think we will also see a loss of trust in in fiat money and in central banks, because actually the distrust in central bankers is probably the biggest bubble that is out there. This belief that the Federal Reserve and the ECB has our back and that they will help us as soon as the S&P is down, not 10% or 20%, but 2 or 3% nowadays. Yeah. So I think at some point, really, the market will realize that the emperor has no clothes, and the fact that we are already talking about measures like MMT or QE for the people, stuff like that, which used to be wet dreams for some monetarists or Keynesian economists sitting in their ivory towers. I think this already shows quite a lot. It shows that this is basically, we're very close to the end game, and that we'll have to do much more dramatic measures in the next downturn. So I think that this huge amount of physical gold that central banks were buying, this shows you some loss of trust in the system, in the measures that were taken, and especially in the US dollar, because it's no coincidence that it's countries like China, like Russia, but also Kazakhstan, Turkey, that are buying huge amounts of physical gold nowadays. But it's also countries in Europe, like Romania, or like Poland or Hungary, buying gold. And they not only bought physical gold for their central banks, they also repatriated this gold, so they don't trust the counterparties sitting in London or in New York anymore. So I think this is a very, very strong sign that we've seen such a huge purchases by central banks recently, and I actually think this will continue in the next couple of years, because there's so much need for diversification and hedging of US dollar and treasury positions. And this is also basically one of the cores of our In Gold We Trust reports, that we want to show, okay, gold isn't, it's not a religion, it's not the answer to everything, but it's a pretty good hedge if you expect a recession, if you expect higher inflation, if you expect a weak dollar, and if you expect bigger correction in equity markets. This is the job and the role of gold. It acts as an insurance and a hedge in those scenarios.
Yeah, a lot of interesting points you mentioned there, and you touched on a couple of times how it's really a hedge against uncertainty or political risk, which I'm curious your opinion, especially you're in Austria, where in the U.S. here, the politics, I'd say if you call it, sounds like an old angry married couple fighting and bickering all the time. That would be being generous. Because I don't think there's any company that anybody would invest in if it were run by the Democrats and the Republicans. I'm curious, and I know, but often around the world, even here in the U.S., people think everything is normal and okay. Has that perception of the stability of the U.S. from a foreign perspective, do you feel like people are starting to notice that more?
It's a good question. I think that if you would openly say over here in Austria that you think Donald Trump is doing a fantastic job and he didn't start any new wars, and that you really support his policies, you would get either ridiculed or kicked out. So I think this is something that where we see a really strong consensus, this anti-American or anti-Trump sentiment over here. But on the other hand, I think from a purely fiscal point of view, isn't it interesting that Donald Trump is now running budget deficits above $1 trillion US dollars, even though the economy is still doing pretty much okay. We've got extremely low unemployment, and we're now in the longest expansion in the history of the United States. So, God forbid if there's a recession happening, then I think we will be at 2 or 3 or even more trillion US dollars of deficits. And I just recently watched a debate between Bill Clinton and I think Ross Perot. Must have been in the 90s, where the only topic that they were discussing during their campaign was how to reduce the budget deficit.
Yeah.
And those deficits back then were, I mean, they were ridiculous to the deficits nowadays. But now nobody is even talking about, fiscal or monetary stability anymore. It's just normal that you run those kind of deficits. And if Elizabeth Warren should become the new president, I think $1 trillion will be peanuts. So I think that we should really, as investors, I think we shouldn't overestimate the consequences of politicians too much. And I really got mad every time I heard the S&P is up or down 0.3% because of new rumors in the whole trade war. I think this is not really moving the needle. I think what's really and we crunched the numbers on that. I think this is really really interesting that there's only a 7% correlation now between the S&P 500 and GDP. But there's a 70% correlation between the S&P 500 and the movements in the Fed balance sheet. So basically, you only have to follow the balance sheet of the Federal Reserve, which already shows you how sick the whole system is and how dependent financial markets are on more and more fiscal stimulus, more and more monetary stimulus.
Yeah, it's incredible. And perhaps I'll offer a quick primer on American politics. You're actually in the 1 year where you will hear about deficit reduction because they talk a lot about it while campaigning. Although, as you quite beautifully pointed out, once in office, not much actually happens. I hadn't realized that Trump actually promised to balance the deficit while he was running, which, of course, we've gone the opposite direction. A few last quick ones for you. I know last time we talked about the inflation warning you had just issued, and if you'd care to update that and share anything further you've been seeing since we last talked.
Yeah, well, our inflation signal is still on a full signal. So we've got the full allocation in commodity sensitive assets like mining stocks. But also in the energy space, I think, energy stocks are very, very much out of favor. They're running a 4% dividend yield and double-digit payout growth. And at the moment, that's also interesting. A mere 5% of stock market cap in the US, is energy, which is close to the record low in 1998. When WTI was trading at $11 per barrel. So if you want to have a contrarian sector, it's definitely the energy space. When it comes to inflation, of course, it is very, very much of a contrarian call still, and it has been for years. But I think that gold is some sort of the canary in the coal mine. We call it gold is the seventh sense of financial markets. So the rise in gold tells us quite a lot, and it tells us that inflation might become a concern going forward. So actually, just some numbers from the United States. Food inflation has jumped to a 5-year high. Gasoline prices in many states are close to breaking above $3 per gallon. I think for the very first time in 6 years. So along with rising food costs. This is definitely a red flag for consumer discretionary stocks. So from my point of view, recession risks are still much bigger than the consensus sees. I think that inflation might reappear at some point, and I think the gold price is telling us that. And Chris, there is at the moment, I think, 13 trillion, so 13,000 billion of bonds with negative yields. What do you think is the biggest pain trade for those bonds? Of course, it is rising inflation. Yeah. And once inflation becomes a concern for financial market participants, and they will say, okay, shit, we need an inflation hedge now. Where will all this capital go to? Will it go to real estate, to equities, or perhaps will it go to gold mining stocks, perhaps Bitcoin? I think if inflation should really become a concern, this is the point when gold will really pick up momentum.
Yeah, and apparently the central bankers are shopping at a different supermarket than I am over here in Denver. So last one for you. I know that you're advising a couple gold companies as well. So obviously you've made preaching to the choir here about gold, obviously, although you make some brilliant points today. And for folks who are into the mining space, your reputation speaks for itself. And certainly I've been interested in a couple of these companies, knowing that you're an advisor, and if there's anything you'd like to share on them.
Well, I'm very picky when it comes to accepting those advisory board roles, because the most important thing for me is my reputation, and that people trust my my business ethics and the way I communicate and the partners that I'm choosing. So there are two companies that I'm currently working with in the mining space, and I've turned down, I would say, 70 other offers. One of them is Tudor Gold. They are in the Golden Triangle in BC. They had tremendous drill results last year. Eric Sprott joined them as the second biggest investor. Walter Storm, an old friend of mine who co-financed Osisko, which became one of the biggest success stories in the last 2 decades in Canada. He is the largest shareholder of Tudor Gold, and we were able to hire Ken Conkin, who was working for Silver Standard and then for Pretium, who is one of the most renowned geologists out there. And last year we've had a tremendous drill season. Now we are preparing the new drill season. And Eric Sprott said recently he thinks that the Treaty Creek property could become a 15 to 20 million ounce deposit. We'll see. We're all excited about the drill results. We're excited about the new drill campaign. So it's definitely a great company. And a great team. The second company that I am a member of the advisory board is Affinity Metals, AFF, which is very, very early stage, but I know the team. They're extremely hardworking, good people. They are having one great project. It's a Regal property close to Revelstoke. It is based on their latest grab samples, they were just terrific, and everybody is waiting for the next drill results. As I've said, it's very early stage. It is a base metals project with some silver to a lesser degree. It's gold contained, but it is something that you should have on your watch list for 2020. But as I've said, it's very, very early stage. It's extremely tightly held. I would say that management knows basically 80 or 85% of the shareholders, and they all know that at current prices, it's just very cheap. So definitely something to follow, but it's not extremely liquid now, and it has a very, very small market cap. But yeah, we'll see where it goes.
Well, I appreciate that. We're actually going to have someone from Affinity Gold on the show soon, probably early February, and perhaps I'll issue my disclaimer. We're not offering legal financial advice here. Although, again, I will just say that Ronnie's reputation speaks for itself. And perhaps in closing, Ronnie, for folks who would like more information about the companies, the Incrementum Fund, or the In Gold We Trust report, what's the best way to keep up on what you're doing?
Yeah, thanks, Chris. As you know, we are writing this small report called In Gold We Trust. We try not to make new all-time highs in terms of the pages. So we try to write less than 300 pages this year, but we're already really, really excited. We started working on the report already a couple of weeks ago. It will be published on 27th of May. In German, in English, and in Mandarin. And besides that, we're having advisory board transcripts that we publish. We're having lots of research about Bitcoin, for example, something that we follow quite closely and where we will also be launching a fund very soon. We are running 5 investment funds, most of them, I would say, in the real asset space, mostly commodities, gold, silver miners. We're doing wealth management for clients, mostly, I would say, in the German-speaking areas of Germany, Austria, Switzerland, Liechtenstein. And that's basically what we do. So we're still boutique, but it's fantastic working for this company nowadays. And I think that the tide has really turned, and that we'll have more support from markets in the next couple of years than we had in the last couple of years.
I think you're quite right, and perhaps next time we talk, you can share the secrets of how you get all this done in a day. I know you got a lot of other projects. Maybe we could get you to balance the deficit here in the U.S. as well. Add that to your resume. But Ronnie, as always, sure is a pleasure catching up with you. Your knowledge is incredible, and also it's just a pleasure hearing you talk. So thank you so much again for joining me. And we'll look forward to catching up again soon.
Thank you very much, Chris. The next time, hopefully video. So I'll hope to have the new webcam then. Thank you very much. It's been a great pleasure as always, and take care.
All righty. Thank you, sir.
Thank you.
So that is today's episode. I do thank you for spending some time with me and hope you enjoyed it. If so, go ahead and hit that subscribe button, and I'll see you again soon.